What's good, everybody? It's Jonah. Come back at you with another video. So for this video, I'm going to do the trade recap and breakdown for Tuesday, July 21, which is today. Right, as you can see in the bottom right, it is 10:58 a.m., which pretty much wraps up my trading session. And so I'm going to do a breakdown. So I took two trades on the S&P. They both resulted in losses. So this is going to be an interesting day because this channel, I want to provide you guys with the full transparency, right? I want you guys to see not only the wins, but also the losses, right? And how I navigate through, because I think that's important information, right? So many traders just want to show all the highlights and all the profit and everything that's done right, but they don't, or they try not to show the moments where they don't get it right or the market doesn't give them what they're looking for, right? So I want today to serve as that, and so there's going to be a lot of valuable information with this video here. So jumping right in like we always do, we go into Forex Factory, and as you can see, the entire week for Forex Factory is completely empty, which means there's no major news events that we're gonna have to worry about, and then we'll be behind the charts. So we just finished the session for Tuesday, so I'll be behind the charts for the rest of the week for Wednesday, Thursday, Friday, right? So now jumping to the charts, we want to first determine higher time frame bias, and we do this on the 1 hour time frame. So the 1 hour time frame gives us a bigger view on the charts, and we can you know get a feel for the overall direction for where price wants to go. And from here, right, we determine our bias, and then at that point we'll basically trade in the direction of the bias, right? We maintain our bias for the trading session. So if we look at let's do the NAS first, right? So we look on the chart to the right with the NAS, right? You see that this high was the highest high that was formed yesterday, and the swing point prior, the swing low prior to this higher move was right here. Now obviously this swing gets traded with this low down here, so now we are anticipating that price is bearish, right? So here, this was the lowest low that was made. So the low, the previous swing low, sorry, the previous swing point prior to that low was this swing point right here, right? And clear as day, that swing point gets traded through, right? It gets traded through up. So then we're anticipating to be bullish. And right, you have this is the highest high, and the previous swing point prior to that move was this low right here that does not get traded through, right? So on first impressions, we're anticipating NAS to be bullish. However, when we look at the S&P, you'll get a complete different story, right? So you'll see that the S&P, previously we had this high here that was, right, this highest high that was formed from this last swing point. Then this last swing points get traded through, right? Obviously with this candle here. So then we're anticipating that price is now bearish. So price makes the lowest low here, and prior to this lowest point, this was the swing prior to this move. Now this swing gets traded through up, right? So now we're expecting it to be a change in direction, and we expect it to be bullish. So then this high gets formed, but this high right here gets cleared by this high, right? This high is higher, right? If I draw a line, right, you see that this high is higher than this previous high, right? Great. So let me get a little closer. So because this was the highest high, right? What is the last swing point prior to this move? It is right here, right? It is clear as day with this low, and this low gets traded through with this candle. So because this happened, um, you know, right before 8:30, this is the 7 a.m. to 8 a.m. candle. This happened right before 8:30. I am going off of this break right here. So to me, going into the charts, right, this is, in my opinion, bearish, right? Is the direction that I'm going with, right? So I entered this day with a bearish bias. Now jumping right in, we'll now look for the 15-minute swing high prior to 8:30. So this aggressive bearish candle down, this is the 8:15 to 8:30 candle. So we look to the left to find what is the most recent buy side liquidity, right? So we have this rate marked here, right? And then if we look at price for the NAS, right, this is the 8:30 candle. We look to the left, right? This high was the high that remained untouched, right? So we have both of our buy side liquidity marked out. So now we want to look for targets, right? So targets, right? This would be an obvious target for the time being, right? Because this is the low of the session and the London lows, right? These were previously the London lows. Obviously, it got taken out. So this would be the immediate target that I'm looking at. But then if I look for targets further down, right? You're seeing targets here, right? Targets down here, which these will be like, you know, very achievable lows, right? You see another low right here, right? So you're seeing targets going down, and then it doesn't have to just be lows, right? You're also seeing fair value gaps, right? You're seeing gaps here. Well, it might be hard to extend, but let me just, right? You're seeing fair value gaps that exist right there, right? You're seeing additional fair value gaps right here, right? So you get an idea, right, of the downside targets that we're looking at, right? The same idea for NAS, right? So for NAS, you got this low will be the low of the session. You got these lows down here, which is the low of London. You got these additional lows, right? And then going down, you got even these aggressive lows here. And if you want to take it very, very, very far for like a long swing target, you can also operate with these lows down here. Now, why are we marking out these lows? Well, because first and foremost, if you look at the vertical line where my cursor has, that is like for the S&P, right? That is the midnight open, right? So if we look a little bit to the left of midnight, that's when you have these lows, right? These are the extreme lows right before midnight. And the same idea here, if you look at the NAS where my vertical cursor is, this is the midnight price, right? And a little bit to the left, this was the last major swing point prior to midnight. So those would be what I would look for to be like my final targets, right? So now we have an idea fully formulated with what we expect to see, right? So now jumping in, right, I'm watching both pairs, right, and we're going to see what happens with price. So we're seeing a push up, which is what we want to see because we want price to reach our point of interest, which is our buy side liquidity, right? We want to see price go higher, so we take it lower, right? The same idea with S&P. We want to see price go higher, clear these highs, and activate the liquidity, and then make its way down. So that's basically the plan that we have going in. So then we're just watching price, and you're seeing price consolidate a little bit. And then here, this is the candles for 926, 927, 928, right? So you're seeing that price already decided to attack buy side liquidity, which is exactly what we want to see. We want to see price push up. So now price purge buy side liquidity. So at this point, we want to wait for 930 to happen. And then when 930 happens, we want 930 to make the high of the session, right? If you look at the brown is the New York. So right now it's clear these highs, right? So right now, price has made the high of the session, but we want it to happen also after 930. So that's what we're waiting for. And then after the high gets made after 930, we want to see a break of structure down, and then we want to see fair value gap left, and we'll use a fair value gap as our entry. So this aggressive bearish candle right here, this is the 930 open. So yes, this massive wick cleared this bullish candle right here, right? So this clearly made the high of the session. Same idea with the NAS, right? This wick made the high of the session, and we're expecting that it did that to clear all of the buy side liquidity. And then we're seeing an aggressive bearish candle to the downwards, right? You're seeing that. So right now, price is looking great, right? It's looking like it's going to give us what we're looking for. So now we're watching on high alert because we want to see if there's going to be a fair value gap that's left, right? Because right now you're seeing that this right now is a space. And if you look at the NAS, right, we're seeing right now these are spaces that are open. So these can potentially, this candle right here can potentially form a fair value gap, especially when you look at the momentum, right? You're seeing this candle is aggressively bearish, which is a great sign. That's what we want to see. You fast forward one more candle, and then we're seeing officially bearish fair value gap form for both pairs, right, on the 1 minute time frame. So at this point, right, I'm looking to take an entry, right, for both pairs. Well, I don't trade both pairs at the same time, right? I usually enter one pair. Ideally, whichever pair, either one like looks better as far as like whichever has more liquidity, right? It's different things that factor in. whichever pair has more like downside targets, whichever pair looks better as far as the setup, whichever pair, has like a better risk to reward ratio, right? Like I'm looking at so many different variables, right? So for example, and here's an example of what I mean, right? Like if you look at the NAS, this candle right here, this bearish candle right here, you can see this wick cleared this liquidity right here, right? You see it went under it. So out of these two pairs, I'm preferring the S&P because these lows are still intact with the S&P. Like I would want the S&P to break structure, right? And then return to this area before finally going down and then clearing this liquidity and then going down, right? So because the NAS already cleared these lows right here, I am already, my preference is already leaning towards the S&P, right? So long story short, I end up trading the S&P, so we can focus on that. But normally, right, uh, we had our targets, right? So for the NAS, you would, try to have this be the super long-term target, right? The super target down here would be super long-term, but then this would be the most immediate target. So I would say if I were to take a trade, right, this I would close at least 80% of my position, like by this point, right? But the focus was on S&P because that is where I took the trades, right? So same idea here with the S&P, right? We have all of our downside targets, so then we would drag this all the way down here, and this is basically the setup that we're looking at that is forming. So let me full screen the S&P. Now we have our sell limit placed because we're anticipating price to want to go up and tap into this fair value gap, right? So then we just watch price, and then boom, right here at 9:35 we are officially in the position right here. So now what I'm looking for is, because I'm in the position now, I'm looking for where to take my first partial profit, and at this point I'm looking at this low right here. So this low, this is the low of the session, right? Because this is brown, this is the New York session, and this is the most extreme low, right? Obviously, it's the lowest session, and this is for a 1 to 1.6 risk reward. So at this point, that is a very legitimate target for my first target, and at this point, I was planning to take, or I did take off 20% of my position. Now, 1 to 6 is a pretty decent risk reward. So you could probably take more if you wanted, right? Instead of 20%, you could have closed off 50%, right? It's up to you how you want to manage the trade, but it's because I was also anticipating, remember, since price is bearish on the 1 hour, then I would have for price to go all the way down here, because if price recently shifted bearish, right, around this area, that's when we seen, this move lower, which cleared like these lows that told me that price wanted to go bearish. Then I'm expecting price to be bearish. So I'm expecting price to eventually want to go after these targets all the way down here if it is in fact bearish. So I have my first target right here for about a 20% partial, and then I was going to take more aggressive partial on the way, right, to close off 50%, 80%, 90%, right, as we went down. So this is basically what I had, and then if we press play, you're seeing price move aggressively, right? That's what we want to see. We want to see price tap into this fair value gap, explode away, which it did, right? You see all these aggressive bearish candles, and then price did in fact tap this low. So I was able to close off 20% of my position. Now, normally, previously, with my prior strategy, at this point, this is when I would roll my stop loss to break even. Why? Because this is like the first low that price formed prior to like the entry, and then price came down, and at least with this bearish candle right here, this bearish candle obviously closed under these lows. So my initial strategy would have had me roll my stop loss to break even. However, the reason why I didn't do that is because now I'm operating with a different system and different logic, whereas I expect that price will want to return to these fair value gaps several times, potentially before making the actual aggressive move down, right? Because this is a good move, right? It cleared the low of the session. That's absolutely great. However, I'm expecting price to want to go into the fair value gap before making its way down because the fair value gap is a magnetic level and price has that tendency. And on top of that, because I already took off partials at this low, that means the total amount of risk that I have open has now reduced, right? Instead of me trading with a full risk, I now have 80% of my risk open, but also, right, so it reduced my risk taking a partial, but also the partial I made profit on the partial. So the profit that I earned also reduced the risk even more, right? If that makes sense. So instead of one full risk, I'm now trading with 80%, but since I made some partial, right, if price were to reverse against me and hit me at my stop loss, um, some of my stop loss is going to go against the profit that, I was able to secure, resulting in an even smaller loss. So let's just say hypothetically, if price went and reversed against me, I would basically only be taking like a half of a risk on the day instead of full risk, right? So we watch price and then price plays out, and then here we go. Price came, tapped the fair value gap again. So then at this point, I'm expecting the actual larger move to happen, right? For price to then make its way lower, right? Because I have so many different levels marked lower. And as you can see, price continues consolidating until price does in fact take me out for a loss. Now at this point, right, I get taken out for a loss. Now, I don't get discouraged, and the reason for it is because that can happen from time to time. It's like you can have your bias and everything can look correct, which it did, right? You have price came up and cleared this buy side liquidity, then price aggressively pushed lower, breaking structure here, right? And then it left a fair value gap here, but also left a fair value gap here. Price tapped our entry with a wick, and then it aggressively repelled from the fair value gap with this aggressive move down here, which in fact cleared these lows, right? So all the signs pointed to everything working itself out and working in my favor. But of course, not everything always works in favor with trading. That's just the art of trading, it's the nature of trading, right? Not everything is going to work. So now I clearly got hit at stop loss, right? My high was taken out. And that's the thing, right? Some traders will see price reversing against them and they'll start getting concerned and then they'll immediately remove their stop loss or move it. And what you need to understand is like, I understand no one wants to lose. I understand no one wants to be in drawdown. But what? Oh, okay, perfect. I understand that no one wants to lose and no one wants to be in drawdown, right? Completely understand. However, what you need to remember is that the point of a stop loss is like a stop loss is there to help you. It's called a stop loss for the reason. Now, it doesn't stop your loss. It just stops your loss from being worse than it would be, right? If you remove your stop loss, then the loss would have ended up being further because price would have continued going in that direction, right? So stop loss is there to protect you in case you're either wrong or price does in fact reverse against you, right? So clearly price took me out, which was for like about a half risk of a loss, right? And then now you see that price came up and then now you start to see bearish momentum to the downside. So while these candles were forming, one thing I noticed is that there was a tiny fair value gap that was left. Now, what you need to understand about fair value gap, not sure this is a smaller fair value gap, but it is technically still a fair value gap. And from my time and my experience working with these charts, now of course, like these fair value gaps here that we took our first entry from, of course, these are larger, more prominent fair value gaps. Like these are more obvious. So like from my experience, these have a greater tendency to hold better because they are larger. This fair value gap, of course, is not as big. However, it is still indeed a fair value gap. And as a result, it still works as confirmation for our entry, right? Because we want a system that is a logical system, a system that is rooted in logic. And what you need to remember is when price is either bullish or bearish, it has a tendency to do certain things because price is controlled by an algorithm, it is controlled by a machine. So there's certain behavioral traits that the machine has and does, right? And one of these things is that if price is bearish, which remember, like even though we took a loss, the logic still holds because price came up and it ultimately um price came up and it still cleared additional buy side liquidity because this will technically still count as a previous high, right? And then now price is pushing down again and it left a bearish value gap again. So at this point, this would fit my confirmation to take another trade. Now, what I did factor in though is that when we entered here, it's not like we entered and then price just blasted through and pushed up and didn't clear any of these lows, right? Like obviously price went down and took some of these liquidity points already. However, when because price was consolidating, right? Price moved up slowly and then it took us out at this level. I notice that these areas also served as, I guess you could say, new targets, right? Like you have a low right here with a gap right here. You also have another fair value gap here, right? You have another low here, right? You have additional fair value gaps here, a low here, lows here, right? Lows here. So even though some of this liquidity was taken already with this aggressive move down, price on the way up was forming new targets. So whenever I take a loss, if price delivers me a re-entry, I would take a re-entry at half of my original risk. So once I seen this opportunity present itself right here, and it's half risk on the second entry, which is what I normally do. But let's just say, for example, if this was the first entry of the day, I would still take it at half risk because this is a much smaller fair value gap. So the point of taking a second entry is not to completely crush the markets. It's so that you can make up for the loss you took on the first entry, right? And ideally just to make up the loss or chip away the loss, or you might be able to make up the loss and walk away with some profit. But technically speaking, yes, this is a fair value gap. And so from my experience working with price and observing these charts, right, that like if price is in fact bearish, and it wants to go lower, then if price taps into the fair value gap, it has a high probability of respecting this gap, right? Have high tendency of respecting this gap and then continuing to go lower. So because now I'm taking a re-entry, right? Of course, you can have your final target to be all the way down here, and that's what I did to potentially swing it. However, because this is a re-entry and I'm not necessarily expecting price to do all of that, like I had many of my targets on this price leg because this is the new price leg that price formed. So this is the new low of the session, right? So if I move um my target down here, this is a 1 to 6.8 risk reward. So to me, I'll be perfectly content with taking 80 to 90% position off here, and then if price decides to go lower, being able to ride price lower to certain targets. But then I started becoming more conservative with my targets, right? Because this is a small fair value gap, and then I also don't expect price to make an aggressive push down. So I had my first partial target right here, right? Like of course there was an obvious fair value gap right here, but I wanted my first partial target to be down here, and then you have targets here, fair value gaps here, blah, blah, blah. You guys get the idea, right? So this is effectively what I was looking at. And so if I fast forward a few candles, right, you see price did what? Price came up, it tapped into this fair value gap, and then it started wicking, right? You're seeing price wick. So that's a sign, usually, that price is reacting and respecting the fair value gap. Um, and you see price does in fact make a move lower, right? So technically speaking, this is a 1 to 55 risk reward right here. Now I could have taken my first partial right here because this is the fair value gap, so I could have taken the partial here, and I guess you could say potentially in hindsight I should have, just because I already took a loss the first time around. However, I still had my mind made up that I wanted this to be my first target because usually I take partials on like the first low that forms. Now, sure, right, price came up and did in fact wick me out again. So I was not able to take any partials, and I did take a second loss. Now remember, I entered at half risk. So on my first entry, which was right here, right, I got stopped out. This, because I took partial and then price reversed, it was basically a half risk loss, and then this was, another, half risk loss, if you will. So from this day, I pretty much took like one full, even those two losses, technically speaking, I pretty much only took one actual loss, and then that pretty much sums the trading day. So if I leave here, you see, of course, price wicked me out, and then price decided to go higher. So that's what took place, and then you can see if we go into the NAS, right? So I still have all the markings for the NAS because a lot of the same logic, like both of these pairs tend to move in tandem, right? So the NAS, right, you can see after 9:30, right, price made a high and then price pushed down. it tapped into its fair value gap, and the same idea here. After price tapped into fair value gap, you see all the wicks. Let me full screen it, right? You see price tapped into the fair value gap. It started wicking, right? And then after the wicks, price rejected. And then what did price do? It ended up going after the low of the session, and then it went and grabbed the London lows. So I guess you can say that price moved a bit better with the NAS because at least the S&P cleared the low of the session, but it was not able to go much further than that before reversing. The NAS, on the other hand, cleared the low of the session and the London lows. So let me see what the risk to reward would have been. Of course, I didn't take this trade, right, because I trade on the S&P, right? So the New York lows would be 1 to 1.79 risk to reward, which is pretty good, right? You could definitely close off at least 50%. And then at this point, right, this is a 1 to 2.30. So at that point, right, to be able to hit the London lows, at that point I would have closed, at least 80% of my position because it's the London lows, right? Like those are very achievable, reachable targets. Um, and you can see price did in fact clear it right before reversing and then making its way back. So let's just say instead of me taking the trade on the on the S&P, I took the trade on the NAS, right? I would have taken at least 50% or a partial here and then at least another partial at this level before price reversing. So then at that point, I would have closed at the very least half, if not the majority of my position, and then I still would have left my stop loss open, which once again wouldn't have been a big deal because I would have already secured profit, and then I would have probably only had 20% of my initial position open, and then price would have reversed against me and would have hit my stop loss, but I basically would have walked away in profit. So in this case, had I taken a trade on the NAS, right, I wouldn't have done a reentry because the reason why I did a reentry on the S&P was because I ultimately did, like, sure, I made price hit my first target and I did make some partials. However, it was still a loss overall on the day, so that's why I looked for reentry. Had I taken the NAS instead of the S&P, right, I would have closed off at least 80% of my position with price going down to this move, and then if price would have reversed against me and taking me out at these highs, right, then it wouldn't have mattered too much because I still would have walked away in profit for the day. So if I walked away in profit for the day, then there's no point in a re-entry because you've technically won for the day, right? I only re-enter S&P because it technically was a loss based on the absolute number, right? And if you look at the NAS wouldn't have given you a re-entry anyways, right? Because your stop loss would have been hit up here and there was never a fair value gap prior to 11, right? Now you're seeing this fair value gap right here, but this fair value gap formed at 1104. So, right, if you think about it logically, this literally would have been the only entry you would have taken, and then there wouldn't have been another opportunity for re-entry. So, depending on how you manage your trade, you could have walked away like having won, right? And so, this is why you shouldn't really concern yourself with taking losses because, right, in this case, if you took this pair, you literally would have resulted in a win. And then if you left your stop loss at where it was at, right, it would have been like a minor loss, but you still would have walked away in profit. Now, for me, of course, I took two losses technically on the books. However, it resulted to about one risk to reward loss. So it pretty much counts as like one loss. Um, and I guess you could say I didn't choose the quote unquote correct pair for the day, or um, that maybe I should have, took stronger partials on the S&P, right? Who knows? However, the logic still played out, right? Like because the logic played out exactly how we expected, and price did reach our first target, right? And the same idea with S&P, right? You see the entry was right here, and then price did in fact go down and hit our target. So I guess you could make the case that I should have been significantly more aggressive with my partials because this right here was the low of the session, and that is a very important target to hit, and price did in fact hit that target. However, the way I was factoring it in, right, if I, you know, zoom back in, right, the way I was looking at it was that, right, let me just put on the 5 minute time frame. The way I was looking at it was that this was the big move, right, from this low all the way to this high that was formed, right? I was looking at all of this price as one impulsive leg, right? So even though this is an important low, right? This is the low of the session. I was expecting price to want to, decide to go down and make a bigger dent in this entire overall price move right here, which it didn't. So, um, sure, losses happen and losses, were on the books, but I don't necessarily see it as a loss like that, right? Because at the end of the day, the logic with this trade did in fact play out. It just resulted in a loss, and that's okay, right? This is just more signs and more evidence that price continues to deliver the same logic over and over and over, and it's just a matter of you being present to capitalize on it, right? So, yes, a quote unquote financial loss was in fact taken, but I don't see it as a loss because, right, everything was playing itself out to the T, right? And what you need to understand too is that this, like, you're not gonna be right every single time. There's gonna be times you're gonna take losses, and there's also gonna be times where things don't fully go in your favor, but that doesn't mean the strategy is broken. Me taking this these losses today doesn't mean that the strategy is broken. There's going to be some days where price just isn't going to give you what you want entirely, or price just isn't going to give you what you want. And those are the days where you can accept the loss and move on and just show up the next day, right? There's going to be plenty more trading days in the future, so there's no reason for you to get frustrated over one day, right? No trader's career should be defined by one trading day, right? And you don't want that to be the case for you. So if today was a day where price wanted to hit just like one target and then decided to go higher, then cool, that's fine. You just show up the next day and then you trade, whatever opportunity is there the next day, or the next upcoming opportunity, because you never know if the opportunity tomorrow or the opportunity the day after or 2 days later ends up being like a super mega trade win that ends up working itself out and giving you all your targets, right? You never know, right? Like, you can't force price to go anywhere. You only just have to react to it and what it decides to do. So that wraps up the video. Enjoy the video. Do leave a like and subscribe as you're on the road to subscribe, guys. So once again, it's Joel, and I'm out. I'll see you guys for the next video.